intent. We're all about education here with Eminae. So this segment, we have a library of material for the past 4 years. We've been doing this. So that this segment, we use it to share with clients and populate it in different podcast channels. So for the sake of recording, I'm just going to restate what we're here for. So welcome today for our M&A roundtable. Today we're going to be talking about ESOPs, which is a great way to exit your business and give your employees opportunity to be owners of your company. So essentially selling your business to your employees is another great way to exit. And today we happen to have a speaker has a lot of experience in this space. His name is Darren Gleeman. He's an investment banker with MBO Ventures. A little bit about Darren's background. He's a financial expert, and he was the founder of eCoupons. I want to hear a little bit more about that, Darren, because you didn't tell me that when we spoke, but I want to hear more about that, your venture there. He's also a managing partner of both GMD Trading and GB Trading, and he's sought after for his knowledge on ESOPs and his financial acumen, as well as being a prolific angel investor. So definitely Darren is a go-to entrepreneur and investment banker for startups and companies in the tech space. Darren, appreciate you joining us today. We've been wanting to connect with you for some time now to talk to our team about what you do as far as ESOPs goes. We did have another company come and talk about worker cooperatives. So now having ESOPs on is very timely to have you on. So welcome. The floor is yours, my friend.
Fantastic. Thanks, everybody. Again, my name is Darren Gleeman, MBO Ventures. We've structured over 350 ESOPs in the past 22 years, over $22 billion enterprise value. And we've also structured helped with the structuring of over $7 billion in the ESOP financing space. So I think the best way just to get into it is just to get into it. I'm going to go into how actually, why someone would do an ESOP, and I'm going to go right into a case study. An ESOP is just another way to sell your company. If you have a customer that wants to sell their company, they're usually looking at private equity, they're looking at strategic. Well, you can also sell to the ESOP, which is where the employees buy it, right? So let's just go head to head. See what happens, see what you think. Let's take a company, $20 million in EBITDA, and maybe a little bit high for most people here, but it's an easy number. $20 million in EBITDA, manufacturing firm, multiple of 5, valued at $100 million. Okay, very simple, 100 million, easy number. So you sell that company for $100 million, right, to private equity or strategic. Number one, first thing is you got to pay your capital gains tax. Capital gains tax about 30%. Across the country, on average, about 30%, which is $30 million. Can't get around that. Yeah, there's QSB stock, but most likely you're not using QSB stock. Bottom line, you can't get around that 30% capital gains tax. Unless you sell to your employees via this ESOP structure. Then the IRS allows you to defer your capital gains. And if you structure correctly, it's deferred forever. So that $30 million capital gains goes away. And that's pretty huge. It's very, very similar. What's the catch? It's very, very similar to a 1031 in real estate, if anyone knows what that means. What you need to do is when you sell your company for $100 million, the government says, all right, you have 1 year to take that $100 million and reinvest it. So you can reinvest that into stocks or bonds or real estate. And of course, when you reinvest it, you're putting a smaller amount of money down. So for the $100 million, normally, right, we make $100 million, we pay the 30% in capital gains tax. With an ESOP, you pay nothing. But if you're going to buy, let's say, real estate, you would put, let's say, 25% down, 25 million, and then the 75 million, do whatever you want with. But that $25 million that you're putting down, you would buy more, you'd buy real estate with $100 million. That's the catch. You can buy stocks, you can buy bonds or real estate. And as long as you hold on to that asset, you don't pay your capital gains tax. That's the actual catch with that. Number two, as private equity, which I'm also private equity besides investment bank. So I'll also invest in companies. I'll explain to you how in a moment. But normal private equity for $100 million deal, what do I do? Well, plain vanilla, I put as little money down as possible. So I put down $20 million of the fund's money. I borrow 60 million, 3 times EBITDA. So I borrow 60 million from, let's say, JP Morgan. That's 80 million. Remember, this is how I'm going to buy the company. I put down 20, I borrow 60, that's 80. There's a $20 million, might be an earnout, it might be rollover equity, it might be a seller note. A seller note is an IOU from the company back to the owner. That's how any private equity is going to buy a company for $100 million. With an ESOP, very, very similar structure, except there's no equity in ESOP, there's all debt. So with an ESOP, go out and we borrow the same exact $60 million that private equity is borrowing. My terms are going to be a little bit better, but same $60 million. The other $40 million is going to be a seller note. It's a bigger seller note. And that seller note, as I said before, that's an IOU from the company to the owner. So 2 questions might arise from this. Number one, what bank, what lender is going to lend without any equity at all? I'm going to say, no way is anyone going to do that. Well, we have a lending stack of over 90 lenders that will lend, and I'm going to explain to you why in a moment. So we can get the lenders. And number 2, that $40 million seller note, that 40% seller note, why do you want to sell a note for 40%? Don't you want the cash? No. You want to take that seller note, and I'll explain to you why. Because if you don't want it, I'll come in. Remember, I said I also invest. I'll take that seller note and work with the management team to take that seller note. So the first thing is the government subsidizes the debt for an ESOP, right? Because the employees, to buy a company, employees don't pay a penny. An ESOP is a complete gift to the employees. It's a structure created by the owner, given to the employees, and again, it's just like private equity. And they get the money through this subsidy from the IRS. What's the subsidy? Normally, you guys have businesses you work with, you take out a loan, or you personally take out a loan, you get to deduct the interest on your loan. But you can't deduct the principal on your loan. So that $100 million loan, right, remember we have $60 million from the bank and a $40 million seller note. For an ESOP, the government allows the company to take a full deduction of the entire principal of the loan in addition to the interest. So the company can deduct $100 million. The company can deduct $100 million, which is insane. And that's just the rules. And that came about back in 1974, that rules. It's been going on for a long time. Remember I said to you, right? So that's why banks, that's one of the reasons why banks like to lend. Because if the company can take a $100 million deduction, well, you have a lot more cash flow. It's the equivalent, especially in New York, it's the equivalent of the IRS giving the company like about $45 million. It's huge and not paying that back either. So that's how the employees actually pay for this. So that's why banks like to loan to it, because it's much more likely to pay it back. That seller note, right? That seller note, 40%, $40 million seller note. Why do you want that? Well, the seller note has a high market rate, right? Because the seller note is subordinate to the senior, to that JP Morgan loan. What does subordinate mean? That means that if the company goes under, the senior lender, the JP Morgan, they're going to get the company. That seller note, the subordinate, they're probably not going to get anything. So it's more risk. Because it's more risk, they get to charge a higher interest rate. So the seller, for the seller note, let's say the market rate for that is about 15%. 15% is crazy high. So we say to the owner, instead of getting 15% for that seller note, you're going to get 4%. But they should be getting 15. That's the market rate. In lieu of the difference, that 11% difference, 15 minus 4, in lieu of that difference, they're going to receive something called warrants. Warrants is kind of like a stock option. Warrants to buy back some of their stock in the future. And they're going to have about 15, 20 years option to buy back stock. And the price to buy back that stock is pennies on the dollar. So let's say they have the right to buy back 40% of the company. Remember, there's a $100 million company. They get warrants to buy back 40% of the company. At what price? The price would be for 40%, about $7 million would be the price to buy back 40% of this company at any time in the next 20 years, right? 15 years down the road, you hand in the $7 million and get back 40% of the company. That's called phantom equity, right? Now with an ESOP, by the way, you don't have to sell 100% of the company. You can sell 30%, you can sell 40%. The magic is 30%. When you sell 30% of the company, that's where the government says, okay, at 30% will allow you to defer your capital gains. I told you earlier, if you sold 29%, you got to pay your capital gains tax. So 30% is the minimum. So a company, an owner does not have to go out and sell 100% of this company. They can sell 30% for $30 million, no problem. Now, if you do sell 100% of the company, if you sell 100% of the company to an ESOP, magic happens. At 100% of the company, when you sell it, the government allows this company to pay 0 federal taxes and 0 state taxes on a go-forward basis forever. So imagine having a company that pays literally 0 federal taxes and 0 state taxes. It's pretty phenomenal. So now imagine a company that you have that is 100% ESOP owned. And remember, you have the right, that warrant, to buy back 40% of their company in the future. So day one, when you initiate this, the owner goes out and explains this to the employees. You stay with me, and you stay with me for a long time. When we go out, maybe we'll do an exit in 14, 15 years from now. But when we do that exit, you as the employee base are going to get 60% of the company, and I'm going to be able to get 40%. And in the meantime, we're running the company completely 100% tax-free. So once you hear all these things, it's pretty amazing. Now, one of the greatest companies for this are companies that actually have been a private equity deal that is busted. Because nobody knows what I just told you. It's not that it's a secret. It's just that usually if you've heard about ESOPs, you may have heard, the technicality of, of what is an ESOP, which is kind of, it's just hard to understand. So you probably heard it before, and you probably have glassed over in your eyes, right? Because normally, if people tell you, what is an ESOP? An ESOP is a Section 401A qualified defined contribution plan that is a stock bonus plan or stock bonus money purchase plan. That's usually what you've heard, and you never heard it because you're falling asleep in 2 seconds. So that's why what I'm telling you, that's what an ESOP is, but no one can actually get it out. An ESOP is the most amazing thing that the government has created. It's something that actually the Democrats and the Republicans both agree. Bernie Sanders and Mitch McConnell both absolutely love ESOPs, and that's because Mitch McConnell loves it for the tax benefits for the owner. It really incentivizes them. And Bernie loves it because at the end of the day, these employees get to become rich, and they really do, assuming the company is growing. Now, ESOP employees, the retention rate is shown to be 300% greater than regular employees, and productivity increases by about 50% per employee. So it's a fairly huge benefit. Now, if you guys have companies or owners that wish to take the company and give it to their children, the structure, in order to do that, they have to sell it to their children, but the children don't have money. So what's the structure that everyone uses? Well, again, take that $100 million example. When you sell to your children, you say, okay, kids, we're making $20 million a year, $100 million after tax, I make $10 million. What we're going to do is I'm going to take a note for 10 years. So for 10 years, you're going to pay me $10 million a year, which is taxed like crazy, right? The company makes $20 million, pays $10 million in income tax. The kids get the $10 million. They take the $10 million, give it to their parents, and the parents pay their $3 million in capital gains tax. Year one. Rinse and repeat for 10 years. It's ridiculous. They can do this ESOP structure, and the kids get those warrants for 40%. The parents get the $60 million up front day one, right? Remember, at the beginning, you get $60 million up front. They're not paying capital gains tax. then within about 3 years, they'll get the other $40 million. Because a lot of times what the banks will do is they'll lend $60 million, 3 times the EBITDA, they'll lend $60 million, and then that seller note, after about 2-3 years, assuming the company's doing well, the bank comes back in and says, I'll take you out for the seller note for the $40 million. So within 3 years, that owner will get the $100 million, and they're not paying capital gains tax. Now, they pay down the debt, and again, they're not paying any taxes. There's not taxes. So you can pay down your debt rapidly, and people do. And then once that debt is paid down, you have a completely tax-free entity to go out and build your company, acquire other companies. Now, when you acquire another company, that's an ESOP. If you're an ESOP and I acquire another firm that's not an ESOP, they immediately accrete to me as a 100% ESOP company, which means that all that net income accretes to me tax-free too. So it's pretty amazing. It's a phenomenal, phenomenal structure. And I will now, if everyone heard what I was saying, you can now give me some questions. And
Hey, Darren, I could sense the passion and the excitement oozing through the screen here, man. I'm very passionate. I do have a few questions for you, but I want to defer to some of our advisors and guests that may have some questions. If not, I'll ask mine.
Yep.
But great, it's pretty fascinating. A lot of people that don't know that they can use this as a strategy.
Yeah, because I think what happens is a lot of people get too much into the weeds and the details of it, and the weeds, they're weeds. So I don't get into the weeds. I just like to explain the benefits. So again, most people don't know really about the benefits of it.
Yeah. So if you want to open your mic, I see Teresa came off mic. You have a question for Darren?
Yeah, I had a question, Darren. It sounds amazing. I can see why you're passionate about it. It's pretty exciting. Like you said, a best kept secret. What's the ideal stage for a company to have this conversation and make this decision? You talked about a 15-year, ownership, participation in the exit ramp. But what's the sweet spot?
Yeah, the sweet spot usually are companies that are mature, low debt. Their EBITDA is at the floor. EBITDA is about 2.5 million in EBITDA and 20 employees. And you're looking at companies that are all the companies that you look around in the next week or week before, anything you see around you, right? I see glass, so a glass manufacturer. I see construction workers, staffing firms, medical companies. Most companies are great for it. What's not good for it are high flyers, high tech companies that are growing leaps and bounds, 100%, 50% year over year. That's not good because they're not going to be able to get the correct price for it. So if a company is growing too hard, like cryptocurrency firm, it doesn't make sense. Those companies, what you want to do is continue and expand it and go out to a venture capital. This is for firms, again, that are more mature. And that they really are looking to take some cash off the table.
Okay. And at what stage is that the stage that you like to have the conversation, the planning conversation?
Yeah, I'll get in front of people anywhere from 3 years before, it's a long cycle. Sometimes I get referrals of people to do it right away because they're ready, the right timing. But yeah, I mean, you can start like 3 years. It turns out an ESOP is a great way to do it. It's a great tool to have in your tool belt. Turns out most people have no idea about it. So it's really about the education. So that's why a busted private equity deal is always great for us, because when a busted private equity deal happens, they're depressed. They're not feeling good about it, right? I mean, it's tough. Now they're willing to listen. And once they're willing to listen, and I usually get this. I usually get, wow, that sounds too good to be true. How is it possible that this exists? And how is it possible I never heard this before? So
yeah. Well, and I kind of feel like it's the just-in-time God bringing this to my information, plate right now, because we actually have interest in purchasing. But I like this structure as a possible win-win-win for our employees downstream, and as well as for our family.
It is phenomenal.
And that actually was my question. I was going to ask you, Darren. So what percentage of the employee salary goes towards the ESOP, and how does that work out from the employees and that are now shareholders?
That's a great question. Absolutely
great
no
question.
percentage goes. Nothing changes for the employees. The employees still have their 401k. The employees get their exact salary that they were getting. They still get their bonuses. Whatever you were doing, they're still doing. This does not cost the employees a penny. This does not affect their 401k. This is just an additional benefit that they get. And it's a pretty huge benefit. And that's why the government gives you all these incentives to do it.
Okay, so go ahead, Andy.
I mean, related to that, does somebody negotiate on behalf of the employees, or is it not needed because they're not putting up anything? How does it
No.
work?
That's very important. The way it works is an owner says, I want to go out and I want to go do this. Great. We do an analysis, see if it makes sense. And then they say, yep, let's do it. Great. We work through a sim. They hire, right? We get 2 employees or 3 employees, a committee of 2 or 3 employees to go out and find a trustee. And we only use institutional trustees. A trustee is a fiduciary that specializes in ESOPs. And the trustee has one goal and one goal only. They need to make sure that these employees pay what's called fair market value. They cannot pay a premium. So that's why construction firms, manufacturing firms, it's great. Like I said, anything you see around you is great. If you have a cryptocurrency firm and this thing is flying and it's making $2 million a year, that thing is worth $1 billion. No, in the ESOP world, it's not worth $1 billion because there's no premium at all placed on it. It's just based on 3 things. It's based on discounted cash flow. It's based on private comps and public comps. And with a cryptocurrency, you're going to weight the public comps and private comps very, very low. So that's why it's good for all the businesses that I think that we all deal with, not for the larger firms. And that's how it comes up with the price.
Thanks.
Darren, on the fair market value, if there's a real estate heavy firm, how would that impact it? Let's say that, cash flow is a couple $1 million, but the underlying real estate is worth 20 million.
And actually I have a company right now, which is actually exactly that scenario that you just said. And for real estate, the company that we're dealing with is great because, not to get into the weeds here, but if in real estate, you don't own real estate in a C corporation. That's the worst thing that anybody could do, is own real estate in a C corporation. Because when you own it in a C corporation, you can't take money out with being taxed on it. So the scam in real estate is, if you structure your real estate in an LLC, you can keep taking money out and not pay taxes on it. You can roll it over, never pay taxes. So if you have a real estate business that's in an LLC, the tax advantages aren't there for you. The company we're dealing with happens to be a C Corp. And it was a real estate firm founded by the grandfather, and it was a C Corp. And when they came to us, they're like, oh, we know that once we sell this company, we're completely screwed because we have to pay huge tax on selling our real estate. We can't get rid of it. Well, with an ESOP, they can. And John, to your question, yes, you would add the value of the real estate back. So if that real estate is worth $20 million, the cash flow is $2 million, and they have other properties that they're managing, for instance. So the value of that business would be, let's say it's the cash flow of $2 million, so that's worth 10, plus the real estate of 20, it's worth $30 million. That would be the value of the company. Unless that $2 million cash flow, right? If that $2 million cash flow is only from the properties, that $20 million property, then no, you can't double take it. Then the value is $20 million.
Gotcha. Thank you.
Sure.
Darren, you mentioned that the capital gains tax is deferred, and you also said it could be deferred forever. When does it become taxable, and how do you defer it forever?
So as long as you hold on to that asset, as long as you hold on to the asset. So let's say it's the $20 million that John was saying. Let's say the value is $20 million, and they go out, sell the company, and they buy another $20 million. Let's just say instead of that, they buy a bond. There are these floating rate notes that you can buy for like 30 years, right? So let's say you buy a Lehman Brothers floating rate note, not Lehman Brothers, that went under, right? Because actually people did buy this, it went under. So the floating rate note product, let's say you bought a Lehman Brothers floating rate product, and let's say it didn't go under. As long as you hold on to that $30 million bond, you don't pay taxes on it. Or I don't like bonds because it can go under. I think real estate is much better. So you buy that $30 million property. So to buy a $30 million property, I would put down, let's say I'm putting down 25%. So I'm putting down whatever, $7.5 million. And then I buy the piece for whatever it is, for 20, whatever, $18 million. I have $18 million. I have, plus the 7. Okay, that's 25 million bucks. As long as I do not sell that property, I do not pay the capital gains tax. With real estate, it's different because I can do a 1031 with real estate. So actually, I can buy the real estate, sell the real estate, and buy another piece of real estate. You can't do that. But let's assume, for this example, they did about 1031. As long as I hold on to my real estate, I'm not paying tax. When I die, as in all asset classes, the owners will get, the children will get a step up in basis. A step up in basis in tax world, that means capital gains goes away for the kids. So that's how then it goes away forever.
Right.
And we structure a lot of real estate. We structure, at this point, we have about, for our clients, we run about $3.5 billion in real estate right now.
Hey, Darren, let's take one more question, and I want to go to the open dialogue, okay? Jeff, were you raising your hand? Or are you just
Yeah.
thinking?
No, I am.
Okay.
So I've been involved in an ESOP company in the past. So Darren, since there are not a lot of them out there, what are the downsides to going to an ESOP?
Here are the downsides. Number one, when you become an ESOP, you now are going to be regulated by the Department of Labor. And when the Department of Labor regulates you, there's a 3% chance of getting audited. Now, the company itself doesn't have to worry about the audit. The trustee does. The trustee, remember I told you this trustee has to get the fair market value, the real value?
Right.
Well, in this example, I'll take the $100 million. The trustee can say, nope, that company, even if it's going to be 7 years later, that company was not worth $100 million. Even if today, even if the company is worth $300 million today, literally the Department of Labor can come in and say, we don't agree with you. We think that company was worth $95 million. And so they have an actual lawsuit with the trustee. So that would be the number one downside of the ESOP. Second downside, if a company is too small, I mean, it's a pain in the ass. An ESOP's a pain in the ass. And so that's why we say the floor is about 2.5 million EBITDA, because you need to outsource stuff. Mm-hmm. And what I found is these smaller companies, they don't outsource it. They think that their executive assistant can do it or their accountant can do it, and they can't. You know, then it becomes a hassle for everybody. So if you do it too small, it's too much of a hassle.
Got it. Thank you.
The question that everyone has that hasn't asked is, what does it cost apart to do the conversion? Typically,
let's just say the Department of Labor frowns upon talking about fees, but all in, the fees will probably be anywhere from, on a larger deal, let's say 1% to let's say 4%. So if it's a $100 million company, that the total fee would be, say, $1.5 million. If it's a $20 million company, the fees might be all in about $600,000.
Got it. And do you do traditional sales as well, or only ESOPs?
No, we only do ESOP.
So if the client, if the client has an offer for a third-party sale, and they also consider ESOP, do you help them with the analysis to see which one is the best option for tax savings or whatever the case may be?
Yeah, a lot of times we'll do a dual track. So we'll work with, usually an investment banker will not bring us in because no one wants, right? You want your own deal. So what will happen is the owner will say, oh, well, I want to do a dual track. Well, they don't know the term dual track, but we'll do a dual track. So the investment banker will go out and do the process, right? And depending on the size, a larger company, you're not going to go out and send out to, 150 different, potentials. A smaller company sends 150 and then you go to the track. A larger company will send, let's say, 15 potentials. And then you go from 15 down to 10, down to like 3, and then it's versus the ESOP. And then just go head to head and see what happens. And then we run the analysis, after tax.
Yeah, I mean, I think was Andy's question. I mean, as far as the downside is that you may not get the full market price, but you do feel some fulfillment. Hey, I've built a really great company, and now I feel that my employees are in position to, to take ownership, right? So
Yeah.
you do have that moral legacy that you're.
Yeah, absolutely. Yeah, in terms of the price, yeah, ESOPs can't compete with the strategic. So if a strategic buyer comes in, just like a private equity really can't compete with it, and they say, let's say a construction firm should have a multiple, let's say today, multiple of 5. Well, if a construction firm wants to be in a certain region and they look at a company and say, I'll pay you 9 or 10, you really can't compete with that. ESOP
Right.
can't compete.
Right.
That's where we would lose deals. And that's
Right.
pretty much it.
But you get the ones that are trouble that, can't sell, and, there's, it's another alternative. So,
Exactly.
Darren, this is very, very helpful, very informative. It was a refresher for me as well. And based upon the questions, it was helpful and informative for the advisors as well. What I want to do for the next 15, 20 minutes is essentially, open up the dialogue. I think, Jeff, you mentioned you were part of an ESOP. So I want to open up on if you guys can talk about maybe some clients you have served that may or may not be a good fit, or what's happening in your Pacific space that may or may not relate to ESOPs. If you can keep on topic, great. If not, if you have something you want to share, I think Mark was talking about, you want to get feedback on deals that went away. Maybe Darren could talk about some ESOPs that went bad. We always like to hear those stories to not make those same mistakes again. Right. So I open the floor up to anyone that wants to jump in.
Darren, does the founder/seller have to exit management of the business?
Absolutely no. The founder and the managers will continue to manage the company. The way it works is you have a board of directors that will now manage the company. Now, if you sell 49% of the company, it doesn't matter. Right, you still own 51%. You still control the board of directors. Once you go over that level, so usually in ESOP, for boring reasons, as I'm for you now, you go from 49%, you go to 100%.
Right.
When you sell 100% of it, how do you take control? Well, the board of directors still governs the company. So the way it works is this trustee, they represent the shareholders. So they're voting the shareholders. Now, these trustees are not running the company. They don't want to run the company. They want the founders, everyone wants the founders of the management team to run the company. So they say, look, we have 5-member board now. Out of that 5-member board, let's say it's Joe and Sally. Joe and Sally, you're the owners. You're going to get 2 slots of that board, and you're going to be there for 3 years. That's 2. Well, it's 5 members. The other 3, Joe and Sally, I want you to choose 3 independent directors that you think would be great for the company. That's how you get the 5 board of directors, which are voted in for 3 years. The trustee is there for a 1-year term, by the way, but the board of directors are there for 3 years. And that board of directors, like I said, they're the ones that can go out, get the management team, which is already in place. So yes, the founders and the current management team are still running the company. The employees are not running the company. Good question.
Got it. Thank you.
Sure.
Rob, I would like to hear your feedback from from a financial advisor's perspective on this.
I think so. As I hear everything, I agree a lot with what Darren says. And to me, ESOPs are great when the company fits. When the company doesn't fit, like you said, they're a disaster. And there's one thing which I was taught the first time I saw an ESOP, which is when you've seen one ESOP, you've seen one ESOP. No 2 ESOPs I've ever seen or touched have been identical, and they've all had the own nuances. But with the right employee mix and the right everything, it's a great tool as long as the company's stable. I think this is an option where you want to retain people and there's a steady value to the company. It's probably one of the best tools out there that you could possibly use in those situations.
Yeah, I agree, Rob. I mean, if you have a company that 2 million EBITDA, 5 million EBITDA, 1 million EBITDA, number one, that company, no one's going to fund, right? As you said, because it's not fundable. So you wouldn't be able to raise the debt that most people want to have money in their pocket. So yeah, I agree. It needs a steady income, low debt company.
Yeah, and I find, I think, Darren, tell me if you agree with me, the biggest barrier to entry is when you do the ESOP feasibility study, when you have to pay that first 30 grand, that first 50 grand to do the accounting and do all the checks, make sure the company fits out. Usually, if a company goes that far into it, they'll go through it and ESOP will go through. So I feel like companies eliminate themselves from the ESOP pool right away when they get that first bill from somebody who has to do that feasibility study.
Yeah, so, and I agree. So what we do is, we do it we're the nation's largest. And we've done the most ESOPs of anybody in the country. And we charge between 5 grand and 10 grand. And we don't even care if they ever pay us. The idea of that's not, we don't make any money on that. So the idea that it's a big loss leader. So we do that just to say that they want to do it. Because if you charge nothing, then everyone will do it. They won't even pay attention to it. But you charge a little bit, let's say 5 to 10 grand. All right, it's small enough that, okay, so 50 grand, you're right. And some of these companies that charge 30 grand, they're tiny little companies. I've seen it. I don't understand how they can even possibly charge 30 grand to 50 grand. And if you see our analysis versus their analysis, we blow it away just because we're just bigger and we're better. We go more in depth. So yeah, 30 grand, 40 grand, 50 grand, it's a lot of money for it, but you know.
Talk about your team, Darren. Are you doing the analysis yourself? Like you say, you guys are the biggest. Let's hear about your infrastructure. Let's hear about the background of your company.
Yeah, so I'm MBO Ventures. And so MBO is the private equity arm for CSG Partners. So as the private equity arm, what we do is, remember I told you about those warrants to buy back a piece of the company in the future? So let's say that's a $100 million company, in our example. 60 million we get from JP Morgan, 40 million is the seller note. Well, what if they don't want the 40 million in seller notes? Okay, if you don't want 40 million in seller notes, I'll give you 20 million of that. So you can take 20 million in seller notes. I'll give you the $20 million, go do whatever you want with it. But now I get those warrants to buy back 20% of the company. So now I have 20% warrants and the owner or the children of the management team has 20%. So we'll come in with a management team. Let's say a management team wants to buy out the owner. Well, they don't need to go to private equity and end up with, you know, whatever, 8% of the company. We'll go out with them and they can end up with not only the ESOP shares, but they'll end up with those warrants.
Yeah.
And we can structure where you can get even more of it. So
it's a great position to be in.
Yeah. Now, yeah, it's a good position. And we can go up and down the scale. We can go from, we can put up $1 million and we can put up over $1 billion. So we have the capital to go pretty much in any size to actually put money in.
Awesome.
And in terms of the size of CSG has about 35 people.
They're the behemoth.
Yeah, the analysts and associates that actually will do all the work.
Awesome.
So I don't do any of the actual hands-on work. We have a team of people that do hands-on work. My background, by the way, previous to this, was something called high frequency trading. That was that GB trading and GMD trading that you spent in my earlier bio. That's high frequency trading. That means that this company, we traded via computers. So there was no hand, I'll buy this, buy this. We found patterns in the stock market and the computers would actually trade. And so when I exited the company in 2018, we were trading over 1% of the entire US stock market every single day.
Wow, that's a lot.
So when I first started that, I was in the trenches actually designing the actual algorithms. And then as I got bigger in it, I didn't do that anymore.
Nice. Well, I mean, it's a pleasure to have you. Great content, very informative. We recorded, we circulated. I'd like to get some final thoughts. If anyone has anything that they're working on, they want to share in the next few minutes, you can. I don't think I've heard from Roy yet. I don't know, any final thoughts from you?
I'm just trying to figure out how to take advantage of this knowledge. That's all. I'm floored, to be quite honest. So that's awesome.
Yeah. I know we had
well, good, Roy, because that means I explained it correctly.
Yeah. We had ICA group. We had Dave, David Hammer. He's there. So they're the reason I brought it up. So what's the biggest difference between the worker cooperative and the ESOP? I think with the ESOP, you can sell a portion of the company. I believe worker cooperative, you have to sell the entire company, if I get that right. That's what it is.
Yeah, worker co-op, I think it's is a structure that I think allows like a lot of multiple companies to like work together, like a lot of farm worker co-ops, and they work together to have like economies of scale, but they're not getting any of the actual tax benefits that the ESOP gets unless they structure it that way.
That's not how I understand it.
How is it?
Yeah, you saying you selling you selling the company to the employees, but I think you have to sell from my understanding, 100% of it to
Okay.
the employees. You do get some tax benefits.
Okay.
But you don't get the full write-off. I think in your case, you get the full write-off, right? So it's a little bit different.
Yeah, I'm not
Yeah.
clear about worker co-ops. I mean, I've worked with a couple in California that again they have these farm co-ops
Okay.
that we had to like work with. But
Yeah.
in terms of the actual worker co-op, I don't know.
Is a similar model? The private equity and invest pretty much purchase they actually finance the sale essentially and they hold the note like what you're saying. Similar process, but it is for smaller companies that are under your threshold. I think you're at 2.5 EBITDA. They started about 500 grand to $1 million EBITDA.
Okay.
And yeah, smaller scenarios. Robert?
Question, Darren, so when you do it, do you handle a lot of like the C conversion if they're like an S corp and everything like that, or do you go through all the different steps to guide them the whole process?
Oh yeah. Of course, we do everything because most companies. I didn't get into that weeds, but most companies, what we want to do, most companies are, let's say, S corps. So the first thing we do is, no one listens to this because it's very boring. We're going to take the S corp and we're going to restructure it as a C corp. Okay, and that way they're going to get their 1042 benefits. That's the capital gain. Then we can't go back to an S corp unless we wait 5 tax periods of 4 years, which we want to get to the 100% S corp status because you're running 100% completely tax-free. So before we do that, we convert it to the C Corp, and then we use those deductions. Remember that $100 million example? Then we take that $100 million deduction over that 4-year period. So now we're going to be deducting $25 million a year for each of the 4 years. So good question. Sorry about that, everybody. Too weedy.
Any final questions before we close out or comments?
I just have a quick question. Any industries that are more, likely to be a candidate for an ESOP?
Yeah, the best candidates really are, as Kyle was saying, it's companies that, for some reason they had difficulty selling. That really is good company. I have a hot tub manufacturer down south. It's a pretty big company. They're about $25-30 million in EBITDA. They went through the private equity process. Now that a recession's probably about to hit, their EBITDA is going to drop, and they think it's going to drop to maybe about, say, 20 million. And so their initial deal that they had with a much larger hot tub manufacturer, they were too locked into the earnout. And they're like, we're not really sure. And then it just came away. So with an ESOP, they're like, look, I want to be able to sell this. How can I do it? So with an ESOP, we can structure it for them. It's just a little bit easier because they're having trouble selling it to this other larger company. But usually construction firms are great, hard to sell. Manufacturing firms are always great because their valuation as it is a multiple of around 4, 5, 6. So those are also great. And I like to work with people. I work with investment bankers and say, look, if you can't sell a firm or you're in trouble, let's work together.
Hey, Darren, I'm gonna send you all my deals that I can't sell.
Yeah.
Rich, how about that?
Yeah, we make.
Yeah, I have one I'm working on right now that could be a potential opportunity for ESOP. We are negotiating. It's I don't want to get into the weeds of it, but it could be a potential opportunity. I'll keep you posted.
Someone did it very recently, another investment banking firm for a bail bonds company.
Bail bonds.
They couldn't sell it because no private equity firm will touch it. It's so toxic.
Yeah.
And it's toxic. So
Yeah.
they wanted to get some liquidity.
I don't know if you saw Mark's post. Mark is doing a survey. Want to get some feedback on deals that may have not closed because the seller backed out. They have cold feet. You have any stories, anything that have happened recently in the last few years where the seller decided this is not for me? You want to go back to like maybe a third party sale and just not sell a company? I'm thinking once they pay the fees for the ESOP, they're vested, right? Because they're right.
This is for Darren, right? Me?
For Darren, yeah.
Yeah. Okay. So our conversion is about 60% once they do the actual, we call it a phase one analysis. That's the one we charge 5, 10 grand for. So most firms, they're in, but they're not really in at 5, 10 grand. But we walk through, what does it look like if you did a private equity deal? What does it look like after tax? The biggest thing is doing nothing. Doing nothing is what most people do. So we go in the analysis, we show, by doing literally nothing, this is how much money you're going to be paying taxes in the next 5 years. And then we walk through how much you would get if you sold it to the ESOP, again, after taxes. And then we go to our lending stack and we say, look, what can we get for this firm? How much money can we get? And at current interest rates, what's going to be the interest? Then we present it. And like I said, our conversion is pretty good.
Yeah, I'm thinking, once they made that, and then there's also some tax consideration. Well, once you start forming that C Corp, you're not going to just go back. So you're already in already. Not, they can't back out at that point.
Oh, once they're in the C Corp, it's already, that's way down the road. That's already happened. That's like, that's like the last possible step. When they're about to get their money and they're about to get whatever it is, the X millions of dollars, the C Corp happens a week before that.
Awesome. Well, thank you, Darren. I'll let everyone out, so we can continue our day, but this has been a great segment on ESOP. Thank you so much. We'd love to, the list of the attendees will be sent out so you guys can communicate and connect. We'd love to have you back, maybe as a guest for our next segments. You can chime in as well. John, it was great having you. And I wanted to learn more about System and Soul, it's called. Almost said Soul Cycle. A quick second. I don't know if you've ever gotten that, but awesome stuff, right? Thank you guys. Have a good rest of your day, okay?
Take care. Thanks. It was great.
Bye.
Thanks, guys. Take care.
Take care.